Hi, my name is Barbara Friedberg. I'm here with Chris Pedersen today of the Merriman Financial Education Foundation, founded by Paul Merriman. So nice to have you, Chris.
It's good to be here, Barb. Nice to meet you.
So, Chris, tell us a little bit about yourself, how you got to the Merriman Foundation, and what the Merriman Foundation is.
Oh, yeah, it's a fun little journey. Like a lot of people, I had been an investor for most of my life, but when I was approaching retirement, it started to become more and more obvious to me that I needed to be a good investor. And so, in my mid 60 or mid 50s, as I was getting kind of into that, I think I might be retiring sometime soon zone. I started studying finance and listening to podcasts and came across a lot of different sources that I deemed good, but I really liked the way Paul presented information. And I really liked the fact that Paul had no conflict of interest. He took his own money, created a nonprofit foundation specifically focused on education. And what he was teaching appealed to me. I'm an engineer by training, so he had a lot of numbers, and that appealed, and a lot of evidence, a lot of historical evidence. And I decided that I would take a page out of my mom's book. My mom worked with a lot of very famous people by just volunteering. And so I called up Paul. Actually, I emailed him and I said, "Hey, Paul, I've been following your work. I'd like to help. Is there anything I could do?" And to my surprise, he phoned me, which is what Paul does.
Paul loves the phone,
He loves
which
the
is
phone.
it's refreshing, isn't it?
It is, yeah, and it's old school.
Yes, I
Yeah,
know. I know.
yeah,
I'm always surprised when he says, "Well, what time should we talk on the phone?"
yeah, and so I remember I was pacing back and forth in my garage, all nervous on this phone call, thinking that I was going to have trouble convincing him I could help him. And to my surprise, he already had work he wanted me to do. And so we started working together. And then, as time went by, I found my niche, my way to help him contribute. And those two things that I really own and help him with are the identification of the best in class ETFs that we use to implement his portfolios. Up until that time, he had a set of family recommendations. So if you want to be all Vanguard, use these. If you want to be Schwab, use these. And the question in my mind was, well, I have a brokerage account. I can use any of them. Why would I pick a family? Why wouldn't I just pick the best? And that involved a chunk of work that he and I kind of explored and discovered together. And then the other thing was, up until that point in time, he had recommended 10 fund solutions, something he calls the ultimate buy and hold. And both he and I thought there might be a simpler way to do it. And he got some coaching from Jack Bogle when he had a chance to meet with him that, you can't expect people to buy 10 funds, rebalance annually, manage a glide path, do all these things on their own. DIY investors just won't do it. So that led us down the path of trying to figure out what we could do to take a target date fund, which we knew was the most popular tool for DIY investors in their retirement accounts, and augment it in some way that would give them a better expected return per unit of risk, a more likely successful outcome. And then that led to various investment strategies we call two funds for life. So it's been a really, really fun journey. And Paul is the world's best boss. He knows I work for free. He cuts me slack. He lets me make life and my family my first priority. But he also is very committed to doing things that'll help investors. And that means the work he and I do together is meaningful. So it's been great. Yeah.
Well, I was looking over your best in class funds before we signed on.
Uh-huh.
And I am through confession. I used I used to be a stock picker and sorry about that. I used to be a stock picker and now I am an index fund investor predominantly, although once in a while I'll buy a stock here or there just because I think I can beat the market. And I was looking over your best in class, and I'm going to put a link below to this list, as well as a link below to a page where you can download for free the 2 Fund for Life book, as well as Paul's books as well. So you're going to get a lot of free stuff in this video. But as I was looking through it, you divide the best in class funds according to asset category, from, large cap blend on to large cap value, small cap blend, on down to a variety of bond and REIT funds. And something that just stuck out in my mind, because I'm very fee conscious, I like to invest in the lowest fee funds, which typically are going to be Vanguard, Schwab, maybe Fidelity. Now came out with some free ETFs that are index funds, which are, insane. They do copy their own index, so we don't know how that will actually play out over the long term. But I saw Avantis on your list, and I was like, I looked them up. They used to be, I think, Century Funds, or they are part of Century Funds.
They're part of American Century Funds.
Their fees are a little higher. So what crossed my mind was, first of all, why did you choose a fund that had a higher than, 0.04 expense ratio for a large cap blend, which is a super easy category to get a cheap fund? And what are the criteria you used to choose your best in class funds?
It's a great question. When we first started doing our work, Paul's background had history with dimensional fund advisors, and dimensional fund advisors is probably, if not the absolute pioneer, definitely the company that popularized investing in some of these other parts of the market, like small and value, and expanded their offering to be able to do it in the US and internationally. But when I started my work with Paul, dimensional funds had no ETFs. They only offered mutual funds. And we knew that a lot of investors wanted to use ETFs for a variety of reasons. So we looked for a company that used a similar philosophy, and the folks at Avantis actually came from DFA. They grew out of that organization. So they were attractive to us from that standpoint, but that still doesn't explain why would you pay more? Why would you pay a higher expense ratio? And something I think that is true in another category that might be worth thinking about in this category is that on the web, we get a lot of services for free. And if you get something for free, the product is you. The product is your attention. So if somebody is selling your attention, they're advertising to you, they're going to everybody who does work has to make money. And when you are getting a mutual fund or an ETF for free, that company still has to make money. How do they do it? Well, they loan out your shares on the back end. That's one of the ways they do it. Now, Vanguard gives you the money that they can make by loaning out those shares back to you, because they're mutualized. They're owned by the investor. Schwab or Fidelity don't have to do that. In fact, they have a fiduciary responsibility to give some of that money to their shareholders. So it's free is always, there's always a footnote to free. So that's one thing to keep in mind. And then the other thing to keep in mind is that when you're buying into a mutual fund, you're buying exposure to parts of the market, be it the small part of the market, the profitable part of the market, the under appreciated or the value out of favor part of the market. And these different parts of the market have different expected historical returns. And you can actually run a factor regression and figure out how much you're getting of each of those different attributes. And if you assume that the future returns will look something like the past returns, you can get an idea of, well, what your expected return would be and subtract out your expense ratio. The Avantis funds deliver enough additional expected return because of their exposure either to small or to value or to profitability that it more than offsets the additional expense ratio. Okay. And I've talked a lot more about that in detail on our website in terms of how we do the selection. We've got some podcasts and things that talk about that. There've been some AAII articles that dove into it in detail as well. But the gist of it is we think that they should outperform that higher expense ratio in the future, and that you'll do better owning, in terms of your total return, reinvesting dividends, you'll do better owning that slightly more expensive fund because it'll have enough higher expected return to cover the cost.
So that was your thought process.
Yeah.
Well, that's a viable hypothesis. So I guess
Yeah, there's
time
no
will
guarantees.
tell.
There's no
Yeah.
guarantees.
No, there are no guarantees in investing. So give me just the cliff notes. What are the criteria that you used to select these best-in-class ETFs?
So the starting point is a spreadsheet where I calculate the expected return based on the historical exposure to these different parts of the market for thousands of funds. Then I also look at things like, is the fund active versus passive, not in terms of its label, but in terms of its historical performance. So if historically it's been very consistent and steady in terms of what it was giving you exposure to, then the regression analysis, which is what we use to do all this math, is going to have like a 99% accuracy model. It's going to say that we can explain 99% of what happened in the past based on just what the market did. If the historical regression R squared number is 80%, then I know, well, there's a magician behind the curtain. There's somebody back there who's doing some market timing and trying to second guess things. And all of the funds that we use have 98, 99% or more explanatory value in the historical model. And so that's the second thing. And then we look at things like how many companies are represented in the fund, because more is better, broader diversification. We do look at the expense ratio on its own. I wouldn't, even if it had great high expected return, I wouldn't put somebody in a 1% fund, because there's no rationale for that. There's too many cheaper alternatives. And we do look at the methodology of the funds that are final candidates, of how it's managed internally, what their criteria are. Make sure that philosophically they kind of agree with this broad philosophy of investing in index funds that are at least systematically managed with very little discretion. And then I also take all of the funds that make up the final recommendation, and I run Morningstar portfolio analyses on them to see what it does to the total portfolio's expense ratio, its total average market cap, its tilt towards small in value, or price to book or price to earnings. You can look at a lot of metrics there. So it takes a lot of time.
Yeah, it sounds like
a lot
you
of
do
time.
a very in-depth. And when you say Morningstar, are you talking about the X-ray tool?
Yes.
Yeah, and that is available to everyone, whether you can subscribe to Morningstar for an annual fee and you get more access, but anyone can use Morningstar for free to analyze their own portfolio. So that's a nice tip as well.
It's a really good thing to do. Take your portfolio and run it through Morningstar X-ray analysis, and odds are you'll find out that you could achieve most of what you're achieving with a total market or an S&P 500 fund. Yeah, a lot of times portfolios end up looking about like that.
Yeah, and I guess the only problem with the historical analysis is depends on your time period, because if you use a shorter time period, it's going to be skewed in one direction. If you use a longer time period, it will be skewed in another direction, because as we all know as investors, there are different periods when different assets either over or underperform.
Yes, very much so. So we use for the expected return calculation, we use about 50 years of historical data because that takes us through several market cycles. And so that is what we use to determine how much the small part of the market or the value part of the market or the big part of the market or the profitable or the less profitable parts of the market should deliver in terms of return. And then we run, in terms of the fund analysis, we run the full history of the fund as much as we can find. And we like to have 10 years or more. In some cases, that requires jumping through hoops and hurdles, but in almost every case, we're able to get something close to that. Yeah.
Well, it sounds like it's worth a look for any do-it-yourself investor. And again, like I said, we'll put a link to the Merriman Financial Educational Foundation and the specific list of the funds. But I want to, before we get too deep, I do want to get into your book
Cool.
because fascinating thesis. His book is called Two Funds for Life. Do you have a copy of it you
I
could hold
do.
up? Wonderful, wonderful. And everyone who's listening will have a link to download a free PDF, or you can buy it on Amazon, get the Kindle version or an audiobook as well on Amazon. So whatever you want to do. But there's a lot of research behind it. And will it be too much of a spoiler alert if we tell our listeners what are the two funds?
No, not at all.
Okay.
Yeah, in fact, I've thought many times that I need to write the Two Funds for Life short and sweet article and get it up on our website, because the truth is we want as many people to know how to do this as possible. The gist of it is really that you take a target date fund, which under the hood is a set of bonds and stocks, and it basically represents the total market, the total international market, and the total bond market, and the amount of bonds goes up as you get older, because approaching retirement, most people want to have more confidence in the balance. They don't want it to be going up and down as much. And even into retirement, sometimes people want that added safety and security. So it continues to increase the amount of bonds going into retirement. And the cool thing is it does it all automatically for you. But what the academics have found is that there is a higher return to be had and some diversification benefits to had by also investing in the small and value parts of the market. So if you add to the target date fund a small cap value fund, or a US and international small cap value fund, if you want to get fancy, then what you do is you give yourself some higher expected return, because those assets tend to outperform the total stock market over the very long term. They have historically, out of our historical 20-year periods of time, they always outperformed, going back to the 1920s. And they tend to zig and zag at different times from the total market. They tend to deliver their performance at a different time than when the big part of the market that's in the target date fund delivers it. So you get this nice benefit that you have a higher expected return during your accumulation years and during retirement. You have a higher safe withdrawal rate in retirement, and you have a small increase in the volatility, not a great increase in the volatility, especially compared to this higher expected return. So it seems really prudent. The reason I wrote the book and ran literally thousands of back tests was to convince myself that it was, because the last thing we want to do is lead investors to something that would be a bad decision for them. The biggest downside is that it's not a strategy that's going to track the market. Anytime you choose to try and have a better return or a different outcome from the market, you have to be willing to tolerate a different ride, a different journey. And so the simplest thing for somebody to do, let's say they're saving 10%. So that's 10 pennies out of every paycheck. Well, they could put 9 of those pennies into or 10 pennies out of every dollar in their paycheck. They could put 9 of those pennies. Yeah, you could put 9 of those pennies into the target date fund and 1 of those pennies into the small cap value fund, and just let it ride. And that's the simplest two fund for life strategy. And that would have these desired effects if the future looks anything like the past. It should increase your expected return, increase your safe withdrawal rates in retirement, and only slightly increase the risk that you have. So that's the simplest form of it. There are more complex forms in the book, but they all kind of go in the direction of how much confidence do you have. If you really believe in this strategy and you're willing to be even more different, then you can put a higher percentage into the small cap value earlier and and reap this higher historically justified expected return when it comes. And that's the hardest part about being different, is you never know when it's going to come. Yeah.
And you have to be really patient because there are long periods of time,
Yes.
like, more than 5, 8, 9 years when the small cap value does not outperform. And you have to trust or believe that in the future. And there's a reason for the outperformance. So do you want to elaborate a little bit on the background of the small cap value? Why is that? Why do our listeners need to believe you?
Yes, I think there's two easy to understand reasons why. The first is that small cap value is it's riskier. You have small companies, so their financial performance, their ability to deliver profit quarter to quarter is going to go up and down more than a large company. There's less momentum. They're not as diversified. They tend to be more concentrated in single markets, have fewer customers. So they're riskier. The fact that they're also out of favor means that the market at large has said they don't believe the story that the company is telling quite as well, and they're not paying a premium for it. And the truth is that many times there's good reason for not believing the story, but the market in the short term is a popularity contest. In the long term, it's a weighing machine. It weighs profits. And what tends to happen is that a few of those small companies, because they're small, will eventually succeed far beyond the expectations of the investors or the market and the popularity they've been allocated. And those companies lift the whole bucket. They lift the whole bucket, and they are what give that category an outsized return. So at a fundamental business perspective, I think it's easy to understand why these smaller companies have more room to grow, why riskier things should have a higher expected return. But there's another piece of it, and that's the behavioral piece. Because these things are a little out of favor and they're a little small and they're a little risky, and they may not deliver a return for 5 years or 8 years or 10 years, a lot of times people give up on them. So there's a behavioral piece as well. And the reward, the return, goes to the investor who can outweight their peers. It's almost like a game of chicken, right? It takes the investor in the value part of the market in particular, who is very well disciplined and can stay the course over the longer period of time than his peers, is going to get the outsized return. And Warren Buffett would be the classic example of that, willing to buy stuff that's out of favor, quality company at a good price, and then wait decades for the return to come in. And similar to small cap value, Berkshire Hathaway goes through long periods of time where it underperforms the market as well. Yeah.
Well, and to further support the small cap value thesis, there has been seminal research on what we call a market anomaly, which is that over more than 50 years, over 100 years, there is a market anomaly that small cap companies typically will outperform large cap companies, and value companies will outperform growth companies, because you are not overpaying for an asset. And small companies, like you said, Chris, they're more nimble. They have an opportunity to grow at a faster rate than a multi-billionaire, billion-dollar company can. So,
If I can just add two other things, the funds that we recommend, in addition to choosing companies that are small and inexpensive or value, also filter on profitability. They look for companies that have better financials, and they can do that and still have a broadly diversified portfolio of hundreds, if not thousands, of companies. And all three of those things add to the likelihood that you will get a better return in the future. And another way to look at this is to look at the opposite. What if I invested in the small cap growth companies? Because everybody's super excited about them. They're the high flyers. They're the ones who have a story that tells you how they're going to be a $1 trillion company in 5 years. Sure, I'm making no money today. I'm negative cash flow. I'm burning through cash hand over fist, but just believe in the story, right? That is the lowest return part of the entire market, is the small cap growth part of the market. So by going to the small cap value part of the market, you're avoiding that. And that's another reason to have some confidence in it, is that you're not getting caught up in the dream that you're being charged too much for in that the small growth excited part of the market.
Well, this may be a new concept for some of you out there. And it's an interesting tweak on the typical asset allocation recommendation for passive index fund investors. I want to again invite everyone to visit the Merriman Financial Literacy Foundation.
It's
And
Merriman Financial Education Foundation, but you're close. You're close.
I'll put a link below so you won't be stuck trusting what I happen to say. And please download Chris's book, Two Funds for Life, as well as Paul Merriman has several books available that can be downloaded for free as well. So, Chris, where can our viewers find you? And do you have any closing thoughts?
Well, I do almost, probably monthly at least, and almost weekly at times, answer questions that come to Paul Merriman's website. And we do that in our free weekly newsletter, which people will have to sign up for to get the free book. So you can find me there. Paul and I do podcasts together. He does a weekly podcast. I usually participate about once a month because I'm doing research the rest of the time. And the content, the evergreen, most important content that we make is all available at www.paulmerriman.com, the website where he runs his foundation.
Well, it was a pleasure meeting you. I really am fascinated by your work and the depth and breadth of your research. I think that's really valuable because it's not a guarantee. Investing, no amount of research is a guarantee for the future, but it's the best tool we have today is to really examine and explore what has happened in the past and see if we can use that data for the future. And you do a wonderful job of that. So
Thank you.
I am so happy to speak with you, meet you. We'll put links to everything below so you can get it. And thanks so much for showing up.
Thank you, Barb. It's been a pleasure.
Bye.
Bye.